Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Welcome back to the show, Ted.
Jim, thanks for having me back, and thanks to everyone tuning in.
I think the way people huddle up around the Fed, it's the way the ancient Egyptians and Greeks and Romans would gather around some shaman cutting up a goat's entrails and telling us the future from it. I don't know if they're any better at telling us what's going to happen nowadays with their so-called scientific scripts and studies and so on. I mean, there's only been 18 recessions since the Fed was formed to stop recessions. But anyway, what did they tell us or hint that will happen in the future?
Jim, just on your point about whether the Fed is any better at predicting the future than anyone else, they do these thought plots. I mean, it's kind of the central bankers pin the tail on the donkey game, where a bunch of them get in a room and kind of try and pinpoint where various economic indicators are going to be 1, 2, 3 years out, and the projections always change, but nobody seems to hold them accountable for that. And if you're a money manager or you're an investment advisor and you pick the wrong stocks, your clients are going to hold you accountable. I mean, I'm sure there's investment advisors listening to this broadcast who know all. If they put their customers in a certain group of stocks and those stocks don't do well, they have to explain that to their customers. But the central bankers, they don't really have to explain much away. And just looking in September, we got their kind of forecast for inflation, what that would be, and basically inflation this year was going to be 3.4%. Well, fast forward and now it's going to be a little higher than that. It's going to be 5.3%. So, in June. In June they were predicting 3.4% inflation, and then 6 months later, it's actually 5.3. So any pretense that these folks have any better clue as to what's going to be happening in the economy than the rest of the society, I think, is an assumption that does not get challenged as often as it should. Yet here we go. We had another Fed meeting, and everyone was hanging on where these thought plots were going to go and show. What will they show? What does the Fed think? Where's inflation going to be? But of course, really what matters is where they think the federal funds rate will be, because it's the only thing they can really control. And even that, they don't have a very good track record of kind of predicting where that will be, and that's what they actually do control. In June, they expected basically no rate hikes in 2022. That was in June. Now, as of the last meeting, which happened today, they are expecting 3 rate hikes next year, basically. So they've gone from no rate hikes in 6 months to 3 rate hikes, and we shall see. So are we going to get 3 rate hikes next year? Well, interestingly, and this is a theme that Bob Hoy talks a lot about, and that really, this is all nonsense. That the Fed sets the pace and sets the policy, that they're basically brought along by the market, and they talk a good game, but at the end of the day, the market kind of forces them to do what they end up doing. And for the last few, let's say, weeks, the bond market has been predicting maybe 3 rate hikes in 2022. And after today's meeting, bond market is still predicting, maybe 3 rate hikes in 2022. So nothing has really changed on that front. And so that's, for stocks and commodities, that's pretty good news, because the 2-year yield did not crack above 0.7%. So that's pretty good. If it had zoomed way up, towards 1%, I think we would have had a lot more turbulence and a lot more negative response from the Fed. But that's not what happened. So that's pretty good news for commodities, commodity stocks. It's good news. It's good news for stocks in general. But the real question now is what happens to growth and inflation. And there's divergent views on what's going to happen next year. You've got a group that think the labor market is got this momentum that it's going to get really tight, and we're going to have a big labor market. Everyone, is going to dodge the Omicron variant, and everyone's going to get back to work, and won't that be great? And another camp that says, well, inflation is going to keep roaring, and you've got another camp that says, no, inflation's going to peak. So you've got all these different views, and time will tell which one works out. But the growth one is going to be really important for the Canadian market. It's going to be important, for energy and the industrial commodities. And I think for the gold market, what's going to be important is has the 2-year yield peaked here at 2%? Is this it? And we don't know, but it's behaving like it could be, but maybe it's just sort of consolidating here before it moves higher. We won't know. So it's kind of what we like to say. I think we're in wait and see mode. Is how we characterized it in our last report to clients on over the weekend. That's really kind of what most of the insiders in Canada are kind of. That cover most of the market are signaling. There's a lot of unknowns. We've had a good run, and we're in wait and see mode. And so I think the Fed is also in wait and see mode. I think that's kind of what they tried to convey today, is that yes, we know inflation's a problem. Let's see how it plays out. So there are those I know that have very strong views that there's going to be strong inflation, for persistently for quite some time. There are other views that are basically 180 degrees from that. The Fed's saying, well, you know what? Let's just wait and see. So from that perspective, it's positive, at least in the short term, and over the next few months for risk assets, I think, for stocks and bonds. Whether it works out for commodities or not, we will have to see how the growth momentum happens, comes along here. There seems to be some headwinds, I think, that are developing naturally here in this expansion, but there's also some positive signs. I think China may be towards the bottom of its growth problems, but you never know. If the Omicron variant prods the Chinese government to go to total lockdown, I'm not sure how they're going to do that with the Olympics coming, but so China is going to be a bit of a wild card here. All the focus today was on the Fed, but I think China is going to get a lot of attention over the next few months. And fortunately, it's not going to be about real estate developers defaulting on their bonds, which is basically been well covered. And this, as far as I'm concerned, those headlines are not actionable. Those have all been kind of digested in the market. What we don't know is how are the Chinese authorities going to deal with Omicron, and are they going to shut down? And so we'll be watching to see. That'll be a big one.
We'll have more with Ted Dixon right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're talking with Ted Dixon. Ted, what's going on with gold and silver? Is it just waiting to see which way the markets break? Because so many people feel they're about to top out again. A lot of, 3 days in a row of at least some of the stock indices in the negative.
So interesting what's going on. I think in the precious metals markets, we're at the gold-silver ratio. We're watching that like a hawk. It's at a very important level. If it breaks above 82, it's just as we speak, it's at 80.6. It's been hanging around 80, 81 for the last week or two. If it moves higher, it'll signal, I think, a deflationary impulse that those people who are arguing that if inflation is kind of peaked and growth is peaked, or one or the other is peaked, maybe you'll get one and not the other. In any event, whatever the mix ends up being, if the gold-silver ratio moves higher from here, significantly higher, it's probably not a good sign for anything other than your gold plays and maybe the U.S. Treasury market. It hasn't broken out yet, but it hasn't broken down either. So we're kind of in a wait and see mode. Now, there's two aspects to that I think are worth talking about. And so first is the wild card, which one cannot predict. There's only one person on planet Earth that knows how this is going to pan out, and that is what happens in the Ukraine. And John Kaiser alluded to this last week on your show on Discovery Watch. If he were to opportunistically invade the Ukraine, I think that would have it should be positive for gold. Whether it's positive for all the gold stocks is another story, but it would be positive for gold, not so positive for anything else. We don't know that, though. There's only one person in the world that knows that. That's Vladimir Putin. So it's a wild card, but so we'll have to see what happens there. I think it's a risk to the markets. But on a positive side, our venture indicator, insiders in the venture area are probably the most upbeat of any element in the market. And I think that's because we got tax loss selling season is in full swing. And so why would they be positive about that? Well, because stocks are going on sale. People are dumping their losers. There have been a lot of losers in the gold and silver and other areas this year. And stocks are going on sale, and insiders respond to that by buying. So that's a positive development. If you're a contrarian, and you can think like a contrarian, there are some opportunities that seem to be materializing there. And so the venture is setting up for potentially a good start of 2022 after all these tax loss sales get done. Those tax loss sales are driven by people wanting to offset. Maybe they had some winners in the energy sector, for example. Maybe they scored on the crypto and earlier in the year, and they just want to have some tax losses. That's not. They're not looking at the price or the assets, the value of the assets. They just want the tax loss. And once we get beyond that, then if the global economy stays on its feet, if we continue to have a Fed that's kind of waiting and seeing, then at least for the first quarter, it's setting up to be okay, I think, for the venture stocks. And so that's one of the more positive developments we can take from the last few days in the markets. I don't think we've got the sort of the full sort of clear signal on the gold stock side, the precious metal stock side yet in terms of the Fed overdoing it. We were worried that they were going to come out potentially and be too hawkish. They're certainly behind the curve in our view, but there is a risk that the deflation camp could be proven right. I think one has to have a little bit of humility in this market in terms of and its economy of what's going to happen, just because there's so many weird unknowns out there. So while the senior gold and silver stocks are not kind of I think set up as clearly as we'd like, I think on the junior side, because of this tax loss selling, because people have been selling, many people have been selling them just for reasons unrelated to the underlying value of the assets. then there's probably some opportunities there, given that we're going into Q1 with a Fed that is still accommodative. They're still buying assets, buying bonds, and buying agencies. No, it's not as much as they were, but they're still doing it. Rates are still at zero. So the underlying monetary backdrop is still positive. So yeah, heading into Q1, we will see. We're keeping a particularly close eye on the marijuana sector, because I don't think there's been a sector more washed out in 2021 than the marijuana group. We have not really seen anything pop up on our stock selection screens that are screaming buys yet, but we're keeping a close eye on a few names. There's been some interesting insider buying happening in the group, but that alone does not give us a reason to get excited. It's a big first step, but a few other things have to come into play, including some price momentum action or very, very attractive valuations. We're getting close. We're not quite there yet, but that could turn in a week or so. So we'll have to see. Certainly, the marijuana stocks are getting help from the bond market. The bond market yields are staying really low, so that's positive. We're very upbeat on the U.S. healthcare sector. We're getting good insider sentiment readings on that. But yet that is yet to translate into a positive outlook for U.S. multi-state cannabis operators and Canadian cannabis stocks, but we're keeping a close eye on that for a potential turnaround, but we're not there yet.
Battery metals always get a lot of attention. Is that a sector that you keep a close eye on?
Oh, for sure. And, that is, I'm hoping that is one. I hope it's not an investment strategy, but we'll have to see in the wake of the Fed meeting here. I'm hoping that sort of the green energy agenda gets back into the focus, and people start looking at a lot of those stocks have been, I think, sold down in the last week or so in advance of the Fed meeting, because had they gotten too tight, I mean, if the Fed gets too tight, they'll just crush everything, right? And so there was a lot of money taken off the table just in case. Well, we didn't get the Fed that showed any inclination to wanting to crush everything. Look, if inflation gets out of control more than it is already, they will have no choice but to come in and crush everything. And that would be the worst case scenario. Great for gold, bad for everything else, except, again, maybe long-dated U.S. Treasuries. But, yeah, we're not there yet. But, again, it gets back to waiting and seeing. And what that means is the waiting and seeing theme, it comes down to stock selection. That means, like, some stocks in some corners of the market will look very attractive just because they've been oversold, or maybe they have some growth opportunities that are underappreciated by the market. It's the stock selection is always important, but in this case, and we've been saying this for a while, I think it's more important than sector selection. We prefer looking at individual stocks and maybe going after broad ETF exposure, and that's I think that's true in the battery metals area and the mining area as well, and especially with these beaten down venture stocks. You have to be very picky. You have to look for quality assets that are just really undervalued. I think there's quite a few out there, but there's also a lot of stocks that don't have a lot of value, and their prices properly reflect that. So stock selection is a hard, tricky game. It's much easier if you have at a stage in the market cycle where the Fed's just starting to pump liquidity into the market. You can go long ETFs, get the broad market exposure, and up you go. But no, I think it's going to be tougher across the board. Even in the tech sector, the tech sector saw a nice bounce, I think today. But look, I think there's some risks happening there, and I think one has to be very careful in terms of the tech area. That when you're looking at that, I think you've got to even if you've got the nice tailwinds of the low bond yields, I think you've got to be very careful in terms of those opportunities and take it innovation by innovation. Same in the cryptocurrency area. I know it's a psychological level, but in all the excitement today after the Fed meeting, Bitcoin could not take out 50,000. Can it take it out in the next few days? Why I think that's important is because if it doesn't take out 50,000, will you get the kind of adoption you needed to keep the momentum going here while the Fed is waiting and seeing, and there's an uncertainty about the direction of interest rates. So it's going to be still a positive environment for stocks and risk assets and commodities, but it's not going to be, I think, an across the board slam dunk environment where you can just kind of buy everything. It's going to be really you're going to be very meticulous, sort of, in terms of where you put your capital, and a lot of that starts right at the fundamentals. I think as we get to this point in the cycle, fundamentals matter more now than they've mattered in a long time, right? And we're all this QE and low zero interest rates, that would cover over a multitude of sins. But now I think quality is going to be in the forefront more than it has been before. You won't have to worry as much about passing up one of those opportunities where, you look at a high flyer and you think, oh, I should have bought that, and that's gone up. Oh, look, it's gone up 50% in 1 week. I didn't buy it. Those types of situations, I think, are going to be less and less as we get closer and closer to the Fed potentially raising rates. But we still have tailwinds helping equities in general. So, yeah, it's time to be nimble, but not time to worry, I think, too much about a big market pullback. The Fed has basically signaled it doesn't want that, at least yet, and it's going to do all it can, I think, to try and avoid getting into a December 2018 scenario. Whether they're successful at that, a lot of it's out of their control. I guess we said at the top of the show, right? They're not all that good at predicting where inflation is going to be and even their own interest rates. So a lot is out of their control, but they've indicated at least that they're not going to be in any rush to pull away the punch bowl sooner than they have to.
Ted, thank you so much for chatting with us.
Well, Jim, thanks for having me on the show, and I just want to wish all you and your listeners a Merry Christmas, and we'll look forward to chatting again towards the new year.
Thanks again, Ted.
Take care.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca, his website, CanadianInsider.com. If you have any questions for Ted, you can send them to info@HowStreet.com, and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.